Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, April 28th, 2025. It's 5:25 p.m. Eastern Time, so the markets are closed for the day, of course. And what I'll do is an update, fairly quick update on the equity markets. I'm going to share some of my trend indicators, both near term and short term. Talk about what happened today. About the only significant development I saw today was the PPO crossover that I was anticipating. Maybe a quick update on Tesla because it is one of the Mag 8 stocks. And then I'll go through in this order. Somebody asked me for an update on coffee and wheat. I'll do that. Update on natural gas. Someone also asked for one of those, so I'll hit on natural gas. Crude oil. And then time permitting, I'll hit on gold, silver, and GDX. Nothing's changed. We still have the recent sell signals on gold, and they have not been negated or taken out. So again, if I can, time permitting, I'll get to those as well. All right, so this is QQQ daily chart here. We're still in the lower part of my bounce target zone that I gave you a couple weeks ago. That's this shaded box right here. Kind of a little bit wider range than the previous bounce target zones I gave you. Has pretty much that's it. So we're there. Now, when I look down at the PPO, which is one of many, many different type of trend indicators I use, you can see here, I'll turn off I'll leave the lines on. If you'll focus here, this is the PPO right here. We'll go back for a while. You can see I have a couple of lines, horizontal lines on there at about the negative 0.57 level there in yellow, and a little bit below that point, what is that, 0.88, negative 0.88 on the red line there. And these are levels that typically define when the PPO is above or below that level, those levels. Again, it's not a hard level. It defines the current trend. Now, when using the PPO, I'll use the 9 EMA as the line that matters. Why? Because that's the last of the two to cross. You have your PPO line, that's the blue line, and then the signal line, which is 9 EMA. And so you can see it's pretty simple stuff, guys. When the PPO, again, the signal line is above it, just going to put a line here on the red line. Let's just focus because that's the one that's been most accurate. The trend is bullish, and it stayed there throughout this entire period since it regained it right here, right there off the lows. You go back, that's we were all out bullish January, coming in right at the start of the year. I think it was January 4th, first trading day of the year. Overweighted on the NASDAQ 100, Apple and Amazon, I believe I listed as my two top picks. And we're coming off that big divergent low, and then we got that buy signal there. And that was the start of this whole trend that took us into the most recent highs. And you can see, again, throughout all of that period except one little tiny whipsaw. And again, we shorted that on the site there. Right off the highs, the divergent highs, sell signals on the 60-minute chart, short-term charts, and then covered with impunity at the lows the morning of there. In fact, even lower than you can see on here because it was in pre-market where we hit the long-term targets in reverse. And so again, that was called a whipsaw. And again, that's just a trend indicator, not that we were long or I was throughout that entire thing. I'm showing you that this is how that trend indicator for longer term investors work, because I keep trying to speak to the active trader and the long-term trader / investor or trend trader. And then again, we went back above there. August 5th, the lows were pivotal low, big correction there. And then boom, just most recently we had for the first time since right here. And again, that was the biggest correction in years right there. We milked it. And then right here, it flipped bearish. And we're still clearly bearish. So from this, again, this is just one of many different type of trend indicators, but pretty effective. And before then, remember, we were in a bear market. There were powerful rallies, correction mode. And again, you can see if you just replicate that indicator, you'll see throughout most of those periods, if you just simply took this, you would have blown the market away. Again, you would have blown away the market just using this one trend indicator, but it's just something else to factor in for the big picture. You can use it as is. I like to use things in conjunction with many other technicals such as trend line breaks or pullbacks to support, rallies into resistance, breakouts above resistance, etc., etc., etc. So there's one. The one I gave you today, most recently, was this chart here. I put up the PPO histogram, but we were talking about, and even last Friday, I believe I mentioned it was a pending bearish PPO crossover, but it hadn't yet happened. That's when the PPO line crosses down below. There's a PPO line in blue, signal lines in white. I jumped down to a 60-minute chart here. Remember, I was just started out with a daily chart, and that was it. So when I said it was a pending, it means it hadn't yet happened. It did happen today, and we did get that red close that I was looking for. It was, I'll speak a little bit to that. Barely red, but red is red. So that 80%, plus odds played out, and I think I even said on Friday, if we didn't get it Friday, we'd get a down day today, and more downside this week. I do favor that. And so what I'm going to do for you here is show you how to use this trend indicator as well. Again, completely different from whether you're above or below the and it's not the zero line. Years back, I learned that many traders will use, or some traders will use this, and they look at the zero line, whether you're above or below it. To me, every security, every stock, every ETF, every sector, every commodity is different. They all behave different. So I look at the chart, and I'm going to do this right now. I'm going to take this white line because times have changed. I had the lines higher before. Last time I updated those horizontal lines on the PPO, we were back here, and it was a different level. But you can see, really since late 2024, certainly since 2025, this seems to be the level right there, about negative 1.10, where the PPO pulls back and then holds, and you rally above there, and you got to rally there. When you're below, it's bearish. When you're above, remember, we've been rallying near term since right here, and that reflects that. So that particular one is there. However, the crossovers are a whole different story. The crossovers will often signal those inflection points between bullish and bearish trend. Again, guys, keep in mind, it's relative to the time frame you're analyzing. This is a 60-minute chart, so this is an intraday chart, good for trend changes. It typically lasts at least a few days to usually a few weeks, somewhere in between there. And so the easiest way to see if the lines have crossed or are likely to cross, other than just a quick visual, I kept showing you that since Friday, that the PPO was going up and then rolling over. And again, you don't have to be an expert technician to take a guess and see, okay, are those lines, when are they likely to cross? You can almost see these are momentum indicators. And again, I really have to stretch it for you to see in the video, and I'll do that. But they are the last 1, 2, 3, what I call high-level bearish PPO crossovers. They have to be above the zero line. There was one there. There's a high-level crossover there. And again, you can do this on your chart and go back and see at each point in time. It's right about here. Here, I'll turn off the annotations. Now, if I turn off the annotations, you can't see all the other levels there. I've stretched and squished prices just to kind of work on this a little more, but I'll pull it back down. I'll turn off all the annotations real quick and just show you again on the 60-minute chart. And I have a little bit more to add to this in a second here. We'll go out to a little bit longer time frame chart. So 1, 2, 3, 4. These are not high levels. They're right around the zero line. I call a high level, when it's well above the zero line. There was one there, and we were also in a bull trend at that point, and there was one right about there. So you can see, without fail, we went from a bull trend and inflection point for, correction, especially for active traders. Some of these were bigger than others. Bull trend, there was a turn, boom. Bull trend, there was a turn, boom. Bull trend, and we'll see. Again, nothing is 100%, but we trade in probabilities, not possibilities here. And so it gets even better if you go out to the longer term time frame. So this is a 2-hour chart, meaning every candlestick is 2 hours of price history. Let me turn off all the lines here. I have the PPO histogram at the bottom. Let me put it up top here so we can work on it. And then the PPO above that. Let's do that way. Okay. So you go to 2 hour, and a 2 hours is a quirky time frame. I'll use it a lot. I'll talk about that. That means, for those of you not familiar, we're on a 60-minute chart. That means every candlestick represents 60 minutes of trading. 2-hour candlestick is common. All platform chartings have them. However, there's 6.5 or 6.5 hours in a trading day. So that doesn't work well. In other words, for the 60-minute candles, you have 6.5. They have to do, they don't have It's not an evenly divisible number by the 60-minute candles or the 2 hours. So they do have, at least this platform has here, a 130-minute, because then you have an even 3 periods in the day. So they're equal time frames in each candle, 130 minutes. So you take that times 3 and you get your 6.5 hours in a trading day. And so either way, you can use, if you don't have it, you can use a 2 hour. And what we don't have yet is a crossover there. So what will happen when I'm using trend indicators, as well as even buy and sell signals based on my typical support and resistance levels, whether it's an uptrend line, a downtrend line, or a horizontal price level. I'm looking for a breakout to go long and bullish, breakout above a downtrend line, or on a short trade, I'm looking for a breakdown of an uptrend line or maybe a breakdown of support. Those are usually my entry points. The shorter the term, the time frame we're on, be it a 60-minute chart or down to a 15-minute chart or even a 5-minute chart, you're going to get in earlier. You're going to get those signals earlier. And when I say that, I'm not talking about just a line waiting for that close on a 60-minute close. I often talk about intra-period whipsaws. If you have a candle that looks like this, let's just go back to, let's just draw a trend line here, and you're waiting for a breakdown, and intra-period, you get a breakdown. It looks like this, but before that candle's finalized, it goes back up. And then you're left with the fat part here that closes right there, and you get the skinny part, which is the wick down below, aka shadow. And that shows you that that was just an inter-period break. So the odds are always better if you wait for the full close there. And again, it's commensurate to the time frame you're trading on. Now this chart I'm on now, the 130-minute chart, what it's going to do, since the candles and aren't finalized, but just over every hour, 2 hours and 10 minutes actually, 2 hours and 10 minutes when each candle is finalized, you can get the sell signals a little slower, but they tend to be more reliable. They have fewer whipsaws. So now what you're looking at here is going back, as long as we want to go back, but I'll just play around with it. And remember, this is just, I'm going to squish down the RSI right now. There's the PPO. All the histogram does, these green and red bars, when the PPO lines cross over, they go from red. When you get a bullish cross, it goes from red to green. So the histogram simply represents the height of these bars, and the color represents the differential, the distance between the two lines. And so when the PPO line is above the signal line, the bar is always green. The higher they are, the higher the signal PPO line is above the signal line, the higher the bars. That's why then when the lines cross, that's why the histogram crosses. Okay, so we can focus on one or the other. It just, for the sake of the video, it's pretty clear to look at this. So we don't have this yet. Now, we did get it on the 60, and I'm going to stand by that. I think there's more downside. And again, there's nothing 100%. Sometimes the histogram bars start to move down, and then like this, right, there's a great example, but they didn't cross. Kept that trend intact, and then the cross came here. But usually, again, guys, these are momentum indicators. They're a huge part of my trading. I extract divergences out of this and other clues or cues, if you will, as to when we're going to get a trend change or a breakout. So you can see here, lines were going down and they crossed. 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 All right? So this hasn't happened yet. My guess is this week. We'll see. And if it doesn't, then it keeps this uptrend intact. That's it. And if you aren't a very active trader, you kind of have a similar trading style to mine, but you want a little more evidence before positioning against a current trend. I'm talking about the current near-term trend being bullish. Then you wait for this one. And I'm just going to show you real quick the easy way to see it. So here's the crossover green. You just take a box. That was green, bullish. Here's red, bearish. And so again, it's the time frame you want to trade off of. That was green. That turned green there, so you milk all that. Again, you could trade just this. There's one little whipsaw right there. Other than that, that's a bunch of red bars catching. And again, these are big moves. Remember, that's one of the biggest drop in many years right there. And there's a green trend. That was a counter trend bounce in the market. That was when we when we went long to go back to bounce back to the 200-day moving averages and my initial bounce targets back then. So you can see, right? Pretty simple and pretty effective stuff. So I'm sharing this one with you. And I'll sit here, toggle all day through various time frames, various charts, and that's one of many. I'm going to show you some more now. Let's go to this board here. Let me flip over to this one. I have, you can probably see it down here when I pop up. I'm on this particular monitor is it's a 43 inch. It's got four quadrants right here on the bottom right hand corner. These are some of my additional indicators, and I'm going to start out in the bottom right here. I'll have to move. You're only seeing in the screen recording that one again when I hover here and down here in the bottom right, and I'm going to go through. Now what I'm going to do is go from the shortest to the longest term, and again, these are just different indicators. I have quite a few, but I try not to get, I believe in the whole KISS rule, keep it simple, stupid. Don't have too many indicators, too many lines on your charts, too many moving averages, because then what happens, it's like holding sand in your hand, or water really. It's just going to slip through there. You're going to miss a lot of signals because you're trying to follow too much, more than the human brain can track. I'll toggle over to these from time to time, and I'm just going to share them with you right now. Let me change the color here on this so it stands out a little better, blue. Okay, this one is, what you can see here, I've created custom indicators. This is something I came up with years ago, kind of figured out how to create your own histograms on various indicators. And so on this one, I use it for moving average pairs. So what you're looking at, you can see down here on the lower left, 12, 13 EMA, 26 and 13 EMA. So it's the two, you don't see them up on the board. They're the exponential moving averages of QQQ on a daily time frame. And so what happens when the 26, when the 13 crosses over the 26, or I should say the 26 over the 13's faster. When they cross, then you get the histogram crosses over. So you can see right here, down on the bottom, and then the other pair, it's similar, it's close. They tend to trigger around the same time, the 39 and 13 EMA pair. So I'm looking for bullish and bearish crossovers. So when you get the bearish crossovers, the histogram goes red. And again, they're very similar. I've just learned that both tend to work pretty well. And you can see as I take the lines up, it did a good job of capturing so far, and tells me that this indicator, which is one of the shorter term ones on a daily, remember, daily time frame, started the video out on a 60-minute chart, then we went out to a 2-hour, and then the 130 minutes. This is a daily chart. This indicator is still clearly bearish. Could it cross? Yes. Again, sometimes you start to go up and it looks like you're going to cross, but you get another leg down, especially in a real bear market. We haven't had a real bear market. I don't consider 2022 a bear market. You can call it what you want, and it technically was, but it was more of a corrective wave, if you will, or maybe even the first leg down in a bear market, if you want to just be a little loose with your definition and call this whole rally up into the 2024, early 2025 highs, just a kickback rally after the breakdown. All right, so it's done a pretty damn good job. Again, green, you're long and strong, right? And that was one little whipsaw. Told you to be long and strong there. It caught that correction pretty well. So again, it's for short term. It's a shorter term trend indicator on the daily chart. It's clearly bearish. You can see back here, look how it captures very well those periods of the big rallies. All of them were caught in there, the nice big rallies, the bulk of them there. It even got you out and or short during the corrective phases, including that big drop into the August 5th lows last year. And so there it is. And then you can see down during that last bear market, it flipped here. We were already short for other reasons, but it said be short. Caught the bulk of all the big, remember, we gamed there were two big counter trend rallies in that bear market. We gamed both of them. And we were long and covering shorts closer to the bottom there before the trend indicator slipped because of the other things that I used, divergences, trendline breaks, pullbacks to support, moving averages, other things. But again, it's done just a really good job. Again, if you just take those boxes and look at the periods where it said be short and periods where it said be long. And so that one's still there, solidly in the sell area. And then we go over, I'll do this a little quicker now you understand how these work. Here's some very common ones that have been around forever. Very common EMA pairs, the 20 and 50 day on a daily chart, the 20 and 50 period EMA, and the 50 and 200 day. So, and on any moving average pairs, if you're not familiar, there's a term death cross and golden cross. A golden cross is when the faster moving average crosses up below the slower moving average. In that case, it would be the 50 and 200 day crossing over, making a bullish cross. And then a death cross, because you'll read about these, are when the key moving average pairs, the faster moving average crosses down below the slower. And so you can see this trend indicator. And here's the thing, here's the takeaway, guys. The longer out I go, we're still on a daily time frame, but now I'm using much longer moving averages. 50 and a 200, they're going to go obviously quicker, get you in and out quicker. But then the 50 and 200, that's a big one. I've used that for many years. I'm not the only one. That's been a popular moving average pair to use in crossovers look for death crosses and golden crosses. We've had the first death cross. And so what you're seeing here when you look down at this chart, or what I'd bring to your attention, is the number of whipsaws are much lower. So there was the cross. There's your red right here. We crossed right here. That's when the death cross came. And it's buried. It's well below there. I don't have to squint to see it. Maybe you can't see it in the video that well. I'll zoom in. There's the histogram. And that means that the 50 is still well below the 200-day moving average, right? At this point. And with zero chance of it flipping back over tomorrow. It could flip maybe later this week, doubtful, but I expect more downside. That'll probably continue to be buried. So you can see this is as far back as this has let me scroll, because we're going all the way back to 2019. It's just a limitation on this particular platform. There was that bear market of 2022, and so I'm just boxing over the red histogram bars. And as you can see, if you were a long-term investor, 401k money, it wouldn't have got you out right at the top. This one would have got you out earlier if you were following the 5200. Right here, would have got you out right about there. But you can see throughout the bulk of that bear market, it said the trend is bearish. On this time frame, this intermediate term, I call it an intermediate term time frame. You either want to be shorting stocks and shorting rallies back to resistance, or you want to be out of your longs if you don't like shorting. And then it flipped right here, and it said, okay, it's safe to get back in the water. All this down here was green, and not even close to signaling. So there's another one right there. And then that shorter term 50 and 20 is clearly on a sell signal too. So now I've just showed you my two of the more reliable trend indicators on a daily chart. I haven't showed these in a while. It's been a while. We're going to go up here and we're going to look at the last two. And they're on a weekly and a monthly chart. So now they're still, I consider this intermediate to longer term-ish indicator. And on this one, I have for you, or I use a 40-10 and a 43-17, and I can go back longer because I'm on a weekly chart, and you can just see how well these things work. And again, they talk to me about the bigger picture, because I've done this a long time. It's so easy to get sucked in a bear market rally and think that, oh my God, look at market breadth improvement. Somebody talked about the Zig breadth thrust or whatever today. There's all these things that are going to come out in the woodwork, and there's all kinds of things out there. The most important thing is trying to recognize the difference, because bear market rallies, I love them. You know that. I love trading them. I love going long in a bear market more than I love going long in a bull market, because they're faster. You make more money in shorter order by far. And we saw that in the last couple months, right? Explosive rallies. Even the one that we're in now isn't half bad. And we were, give you that pullback of the trend line. It's gone a little bit further than I thought it would, but we're still well within my bounce target zone on the daily chart that I start out with. So let's just go to this trend indicator here and take a look at the history of it. So again, a 40-10 and a 43-17. Again, that's on a weekly chart, not daily. So that's a 43-week and a 17-week exponential moving average. Again, the histogram up here, I have them. This one on top, the lines, you might be able to see it in the video. There's your 43 in purple and the 17 in green. I don't have the 40 and 10 because that would it'd just be too busy for me. But you can see, I'm going to zoom in. Well, before I zoom in, let's show you. This was the dot-com bubble. For those of you old enough to remember, this was a a parabolic blow off top, an unprecedented time in the markets with everything .com behind it, just similar to AI, just even more. It was on AI on steroids, the AI bubble. And it said, hey, guess what? You're in a, it was long and strong. And overbought became so much more overbought and stayed overbought for a period of time. So any short sellers, fortunate for me, my forte into short selling came a little bit after that time, somewhere, was it back in the 90s? I can't even remember. I fell in love with technical analysis back then. Yeah, it was actually, it started, but very limited at that point in time. This is where, in recent years, where started more aggressively in honing my skills on short selling. Back then, I was working actually as a financial advisor, stockbroker in the .com bubble, and it was and it said without any exceptions, the trend was bullish there. Then the bubble burst, and again, you're on a weekly chart, so it's not going to get you out at the exact top. But my God, the amount of money it would have saved. A lot of people were just steamrolled back then. The Nasdaq fell almost 80%. It was a 78% drop from high to low, the Nasdaq Composite. And so both these indicators, as I'm boxing right there, got you out near the top and got you back into the market long right off the bottom. So again, the track record on this indicator is very good. There are some, again, some are better than others, and that's why I look at multiples. So I'm going to zoom in. And other than that, we've been in a, other than the financial crisis, which I'd be remiss not to hit on that because that was a big one. Most of that, it's again might be hard for you to see in the video, and it doesn't look like much, but that was about a 56% drop in both the Nasdaq and the S&P 500. And these indicators, for the vast majority of that, other than this first big counter trend rally, briefly, they were red. It did the same thing. It saved you from losing a lot of money in your 401k, or it turned around and allowed you to profit immensely on that very, very profitable to trade bear market back then. And then we've been in really since 2008, other than COVID and few exceptions. That's when the Fed started to learn that started to feel they were omnipotent and could just, every time the economy hiccuped or burped or the stock market had any type of correction, they would throw more money at it, initiate another round of quantitative easing. When they tried to start backing up on taking back the easy money, the zero rates in 2018, the market threw a hissy fit. But other than that, as you can see, and there were a few corrections along the way. And if you have to zoom in and see that these, even if you took the signals, that one you would have been a little too late on, because that was the 2018 fourth quarter drop. And again, we were short that off the highs and covering at the lows for different reasons than this one. And expecting the reversal there, expecting the Fed to pivot. It was written at the time. But I just want to show you. And again, so think about, 401k indicator, things like that. This is a longer term one, and it would have had you, even if you just took it religiously on faith and sold longs and got in, it would have got you back into your longs shortly after when those indicators flipped, and you would have vastly outperformed the stock market. So, hopefully these kind of things that I've built over the years are useful, and you can incorporate them to your long-term trading, or help filter out the noise and help you ascertain what's a bear market rally or a legitimate trend. And so right now I'm going to zoom in, and then we'll get to the next one. The 43.17 fired there. Before that, the 40.10's a little faster. It signals first, and it said all this, and that was that big 2022 bear market correction. Got most of that, said stay out, and then both of them flipped at this point. You had one flip here, bullish, and the other flipped here, and all that said long and strong for 401k type monies. This right here, you can see we're kind of flattening out with the recent trading range we're in. Again, I'm on a weekly chart. That's why it looks like things are flattening out. We're really nowhere. We haven't gone anywhere in the last few weeks. We went down, and then we went back up, and we're back there right now. This one has fired. Remember, this is the quicker of the two. This one's sitting right there at 0.03, waiting for a crossover. So now what I've just done, remember I've gone my third indicator out to the weekly chart. Everything's bearish so far. This one's close. And if we close the week solidly red this week, or especially next, also, then it'll flip to bearish, and it'll flip to bearish for the first time since early April of 2022, when there was still plenty of meat left on that bear market on the downside. And then last but not least is, at least on this quad board I have, my longest term. This is a monthly chart. This is, I have my beloved 20-month exponential moving average I've shared with you, and that's a very simple, that's not a pair, that's a single moving average. It does a phenomenal job. I'll get to that in a second. But so on this one, I think, as you can hopefully see in the video, unless you're watching on your mobile phone, you've got a 10-6 pair and an ROC 12, rate of change 12. It's a whole different thing. It's not an indicator. I'm sorry, it's not a moving average pair. So the 10-6 is, and the 10-6, again, now we're on a monthly time frame. You have no whipsaw. The last time, they're only going back here, you have the entire financial crisis, or most of it, in that bear market caught there with red, and also on the ROC 12 right there, and or I should say right there. Green all along here, all green, long and strong on this long-term indicator monthly. Back there, we had it red here, so it captured the bulk of that bear market, and it's still green. So there is still, as I've said on this one, on my beloved 20-month exponential moving average indicator, which I'll get to here real quick. I'll show you that here for those new. This is a QQQ. I've shared it on SPY as well. It's this blue line here, that 192. I can just mute that down. We don't need to see that one right now. That's it. And I've talked about this recently. Today is April 28th. Wednesday will be the 30th. Right now we're above it. And to trigger a sell signal on this indicator, you have to close a month below it. So we'd have to dump. Let's measure it out. Here we are today. We close right here. We have to dump 3.82 or 4 just to get there. And if we close on it, or just a hair below, if I have to squint to see if we're above or below it, I say no, don't. That's you're jumping the gun. You can take it if you want, but you want to see it clear, and that's usually what you get, what I call a solid monthly close below it to flip the trend indicator to bearish. And so that's where we're at. So it could possibly happen here in April, or it may, let's see here. Oh, no, sorry guys, I didn't, I moved my charts, but I didn't move the board there. Yeah, remember, I'm looking at a much larger monitor and capturing part of a section of the screen, so I had flipped back to that chart down below, but I didn't drag the screen capture window, and so I was talking about this chart. So there it is. This is QQQ, and you'll see the similar thing on SPY. That's that 20-month exponential moving average. Again, it's a 20-period exponential moving average on a monthly chart. I'd give it a 10. If there is a 10 on any trend indicator on a scale 1 to 10, and I rate that for not just effectiveness and accuracy, but also simplicity. It's not a 2 or 3. Some people use 3, 4 moving average pairs and custom histograms or other indicators mixed in. And again, so if you're looking for just simplicity, you want to be long when the stock market, either QQQ and or SPY, ideally both, are above. You would have captured every bit of that huge rally, one of the biggest, if not powerful, bear markets in history back in the 90s up to the dot-com bubble. It would have got you out and kept you out throughout the whole big 78% drop in Qs, and got you all in through almost all of the next bull market, got you out in the financial crisis through most of it, and then kept you long and strong here, other than that bear market we had in 2022 right there. Even COVID, it didn't get you. COVID was a one-off. We closed the month right on it. Fed, it was a 6-week drop, but the Fed came in, and before everyone even knew there was a bear market in the works, the Fed ended it, and the federal government as well, fiscal and monetary stimulus, and not just the U.S., every country in the world. So again, it would have kept you in your 401k, and where you can't actively trade anyways. But here it said get out, and there it said get back in, and that's what we're waiting for. You can see also the PPO histogram on the monthly chart. Remember, I started the video talking about the PPO histogram on the 60-minute chart, right? Same thing happened, and I've covered this. I covered it a couple months ago, that I was watching and expecting and looking for that, and it did flip. That was the month of March. This is April. No matter what happens in April, again, this is up in the air. This we could easily, in 2 days, if we drop far enough, get below there, or we'll have to wait and see if we get that signal in May, again, from a monthly close. What I can tell you pretty much definitively, this is not going to whip back over to bullish. This is not a whipsaw. It can ultimately prove to be next month, but it's the histogram is too far low as we have 2 trading days left in the month for this to signal back and make this a whipsaw. So that is a powerful, my point is, this is a powerful long-term sell signal there. The last time we had it was right there. And what did you want to do? Buy in your 401k and go long, or your long-term funds, or did you want to short? You definitely wanted to short that or get out of your longs. And before that, we had one right there, and it doesn't look like much, but from high to low, that was about a 23% drop. That was the big Q4 of 2018 drop right there. And then we had a sideways market there where it went down from high to low as much as almost 20%, 25 actually right there. That was in 2015. And that was, if you're wondering why, how I came up with the number of measuring, and I remember because I was trading at the time, there was a flash crash there. QQQ went down from high to low about 26%, but the NDX and NASDAQ 100 didn't. QQQ does a very good job, a very, very good job of tracking the NASDAQ 100, but it's not perfect, and it is an ETF, and that's why you have the disparity. If you're a purist on these charts and go back and say, Randy, then NDX, the NASDAQ didn't fall that much. QQQ did, and if you were in it, you lost that much. Your stops got hit. They didn't reverse those trades. It was a kind of a mini crash, flash crash there. And again, it already told you you were out of it before it happened based on this indicator. So that's it. I might have to truncate the video because these trend indicators, we're 36 minutes into it. We got the red close today on the daily chart. It wasn't by much, but it was red, so that counts. This trend indicator and everything else, a lot of them I showed you are still bearish right now, and nothing's changed from my bounce target zone. Price action, I mean, yeah, we spent 80+% of the day. This is a daily chart. This right here, 4 p.m., this is Friday's close right here. So this is what the market did today. It started, paused, gapped up, opened up, went down a little, went red for a second, had a little stop blowout thing right after the open, then went red right here. This yellow line is Friday's close. So you can see here, we spent probably 90% of the day red, got green there for a second. They were probably just blowing out the binary options traders that are betting binary options or the single day options where they're betting on a green or a red close. It's very manipulative looking to me. Either way, look, it's not a high five, but it is that red close, and it gave us that bearish PPO crossover. So we added the trend change flip. That's it. All right, nothing else to add there. SPY also closed red as well. And that was it. Same kind of price action there. Daily chart, I believe it closed red. I know the futures did. Believe they did. Either way, QQQ is a vehicle I was trading and calling for the red close on anyway. So that's that. SPY might have closed. I don't know. Watch it, but it was flattish. Okay, as per subscriber request, somebody asked me to update wheat. Wheat still, this is that 25-year trend line. This is the 2000 lows. That's on the .com bubble burst in 2000. And I've covered this many, many times. This is a long-term uptrend line right here. Let me make that dark blue so we can see. And I've highlighted it back here. We hit it. We're still above it. I've highlighted long trades back here. We caught that. This was, the notes from the time. We had positive divergence and pulled back to long-term support. Also had it here as well. It's a trend line I've been tracking forever, and we're there. We hit it there. We had a bounce, and we hit it again. And this is what I've been saying for several months now, into even late last year. Next buy signal is going to come on a break of this downtrend line. You have that bullish falling wedge. We just can't get started, but it's still holding that primary uptrend line support. So it's in what we call a very large secular bull market with rising prices, but within there, and we came off, remember, we had this parabolic top right here, and with the divergent high, and that sent us back down to the trend line. So that's it on wheat. It just has to start taking out some of the overhead levels. if that's a long-term chart. You can also trade. Look at the wheat ETN WEAT. Same story. It keeps inching down, popping up, making these divergent lows. Big positive divergence. And when wheat wants to run, it can really run. It just every time it starts to run lately, they get sold into. So it continues to be more of a better swing trading vehicle. And I like it. I have long-term positions in wheat. I just continue to roll the futures in one account and WAT and other accounts, so I don't trade futures. And but waiting to add to that, it's just going to have to start. What you need to see is basically the makings of a new uptrend. You have to start taking out some of the previous highs there, and then it should run. But that's it. So there's no other than it's at long-term support. And if you're trading off the chart I just started, was a weekly chart. It was 25-year uptrend line. You got to be patient if you're trading that. That's not an in and out thing. In and out, you can just hone in on the 60-minute charts. Let me put my histogram away, get rid of that. We don't need that anymore. Turn back on the lines. Last divergent low, and this is just simply an extension of that previous divergence. So whereas now it indicates an even larger rally once we get a trend reversal here. Probably put a secondary trend line right here. That's the one to watch now because that last breakout failed. And that's it. Pop. And then we still have those longer term targets. I was also asked about coffee. Let me go back to this chart here. Find my coffee chart. Go to coffee. Oops, let's go to coffee weekly. Where is that? Right here. Coffee is mentioned recently. Put in this parabolic top. Coffee every now and then tends to go more than a lot of commodities, tends to just go parabolic. It just loves to do it. Did it back here. It's done in the past. And coffee is usually full throttle up on rallies or full throttle down. That's how that beast trades. It's either going up, going down. Sometimes it'll go parabolic. So it broke the parabolic trend line. I think I can go back a little farther here. Let me see if I can go back a little bit further for you. No, let me just leave it here. We're already on a 20+ year history. So if you can see, I have to zoom in for you, which I will do now so you can see it better. Let's go back just 3 years. Zoom in on that. It broke the parabolic uptrend line, has a little kickback rally, and I suspect that's going to fizzle out soon. Could go to, look, if it goes and can pop and make a marginal new high anytime soon, we're going to have negative divergence here on this weekly time frame. That's going to be really nice. But as I mentioned, sometimes when you go parabolic, you don't have the divergence. So that's it right there. I don't have a strong, I have a strong long-term conviction on where it's going. Near term, it's a little fuzzy right now. But we saw that the last time it went parabolic as well. Let me go back to a little bit further. What was that? Go back 10 years. Yeah, you can see we went parabolic right here. Started to run parabolic there. Broke down. Had a couple kickback rallies, and then the rest where it fell. Nat gas, I gave you an update today. Somebody asked me, I'm sorry on that. Yeah, we hit the second target on the 60-minute chart. A couple more targets. Remember, this is stockcharts.com uses the end of day pricing, so they only show end of day, Monday through Friday. We hit to the button that long-term target I was calling for since 2024. We started going long. Gave a sole final target, maximum target of 490, which we hit to the button, but it was on Sunday evening when the futures open up, and so that's why you don't see it here, because it was a perfect reversal. We got out, I posted it. It was a rare. I came in, even made a post Sunday night, made a point to tell you we hit that target. It was a good time. I was reversing, pulled back, and that's what that was. So, but bigger picture, all along on that trade, I always said I could see the potential we could come up here. So somebody asked me about it. They asked about, Randy, long term, do you see more upside in natural gas? Other than you have my near term, because that's an active trade. Yeah, I see a little more upside near term. I'm not holding out for, I'm not positioned for this right now in long term accounts like I was for the 490 target. My confidence isn't super high. But again, the points I made back here, I'm just reiterating what I said back in 2024. We're coming off one of the biggest divergent lows, huge positive divergence. And that's my thing. I like these divergent lows. Pointed them out in the past. measured out for you. That one was a 223% rally, 158, 233, 207, 563, and this one was 189, 190. So that's why. So my final target, as profitable as that was, almost a 200% run, it was actually on the lower end of the average return for natural gas coming off periods of divergent lows. Not to mention we're in an inflationary environment. Sure, inflation's abated since it was really hot a year or two ago, but by a lot of metrics, I think we're going to see elevated and persistent inflationary pressures. And the other thing, I didn't answer this in that reply with this chart that I gave to in the comment section today. And that would be crude oil. I don't know which chart to queue up. Let me just go longer term here. I'll go 20, 30 years. This is crude oil, WTIC. And if, and that's a big if, guys, if I'm right on my call for not just a recession, but a different type of recession, different type of bear market going forward for years to come now, much bigger stock market correction, much bigger bear market than most can envision right now in the stock market. Again, I'm talking in the coming years and by the end of this year too. If that happens, we will almost certainly see demand destruction for crude. That means crude prices drop down. That's what tends to happen. There was the financial crisis. We had crude went really sharp up there, had a huge drop off. That's what happens during recessions because planes, trains, and automobiles aren't using as much fuel. Manufacturing plants, petroleum-based products, which are a lot of things out there. So you get the picture. The demand for crude oil drops off. It's almost possible, very, very difficult to see a scenario where you have a clear and prolonged recession and crude prices rise with that demand falling. So if that happens, then what happens is the wells start getting capped. It's certain wells aren't no longer productive. So the oil drillers will start shutting down wells, and then that also decreases production of natural gas and then can cause natural gas prices to go up. So that would be a fundamental thing, but then sometimes natural gas can, and it did fall back in 2008. Everything fell. The financial crisis back then was a liquidation period, and so everything was getting sold. Even gold, by the way, guys, got clobbered back then because there are times where everything's in liquidation, and the same folks that are chock full of Apple and Nvidia, they start getting margin calls, and if they don't sell it, the broker will, and they might have a bunch of gold in their account, and that gets sold. So that's a scenario there. Again, I go off the charts, and I just told you my long-term outlook and convictions on where natural gas isn't very strong. I just wanted to give you that update. And again, I'll continue, and you can always bump me for posts. I'll give you my outlook, but at times I may tell you it's not strong, the long-term outlook or the near term, but right now I obviously have a near-term bullish position, near-term bullish outlook. But we hit the second target today, so we probably get a reaction there. Right here, that's natural gas, that's T2. So in one day we hit T1, T2, and we got these next two targets. If we can do this, especially in the next few days, because if we do it in the next few days, it would be nice. That way we can get up there, go ahead and hit that trend line. Let me color that a little different here. Get up there. Whether we pull back or any pullbacks to support always provide objective entries, but then you have the downtrend line plus price resistance. That'd be a nice, what is that? Quick little whatever it is. Okay, I'm going to skip gold. Like I said, no change on the daily charts. Remember, we had the bearish engulfing candle, island cluster top, divergent high, and whatever else. The dollar pulled back today, therefore gold and silver rallied a little bit, nothing much. And again, the recent sell signals are intact, so that's still an active short trade there, gold, silver, and or GDX. I'll wrap the video up here. This has been Randy Finney with Right Side of the Chart. Have a great day.